All right, so we officially have 2 weeks left in 2023. The markets are at bordering on all-time highs, definitely yearly highs. And I wanted to make a video about my top stocks going into 2020 or 2024 and beyond. So again, if we look at the S&P, I mean, we closed over 4,700 yesterday, which is just crazy. I mean, we're up what? 14% since the October lows, and if we check on the year, we're up about 22, almost 23%. So this has been a very good year for stocks. Again, obviously there's 2 weeks left, but the chances of anything significant happening in the last 2 weeks is very low, considering volume's going to be lower, considering more people are going to be off. And I think people are closing out the trades for the to close out the year. And again, typically markets will at the end of the year do more of what they did during the year. So obviously anything could happen. I wouldn't rule it out. But 2 weeks, and not only that, the markets will be closed on Christmas, so that there's not even 2 full weeks left. So that is the market on the year. Again, I will make a separate video on predictions for 2024. Today, I wanted to make a video on my top stocks for the next decade, 2 decades, even 3 decades, right? And again, I have 20 names on here. I do have 5 honorable mentions. And my criteria here is not necessarily which ones do I think are buys right now. Again, obviously everything here, my opinion, do your own research. These are, again, you're forced to only hold 20 stocks, right? Or even 25 stocks, right? So let's get into the honorable mentions, and then I will get into the official list here. Domino's. Again, this is pretty much every stock on here I believe I've talked about before. Again, this is a stock that's historically performed very, very well. It's not up nearly as much on the year. It looks like it's actually been fairly volatile, but this is a company that I think is going to grow well over time. It's going to keep growing. It's always grown very nice, and it's a dividend growth stock, which is those are the exact kind of stocks that I love to buy, because not only do you get those price returns, you also get those nice juicy dividends. Now again, it's only a 1.2% yield right now, but again, they're growing 17% per year. So again, this is a company that I really like over the long term. I still think they got a lot of growth potential. The next one is Extra Space Storage. If there wasn't a concern with rates and stuff, this would definitely be in my top 20. But this is a company that got hit really hard this year, and they actually managed to close. They're actually looking like they're going to close up on the year, even though they were down. I mean, they were down about 27% at one point, which is pretty crazy considering how much the market as a whole has been up. So again, I still really like this space. I think self-storage is a space that I think everybody needs at least some exposure to, but they're just not quite good enough right now, because I think rates are going to be a little bit higher than they were, the next decade, as opposed to where they were the last decade. The next one is Go Easy. Again, this is a company that's performed extremely, extremely well over the last decade. They've been absolutely destroying things over the last little bits. I actually bought them around $91. Again, this is one of the times to where people always say you can never time the bottom. I almost perfectly timed the bottom with this company. I bought up a pretty sizable position, and not crazy, but at least about 5, 6, 7% of my portfolio at $91, and you can see this company bottomed out at 88.5. Right, so I almost perfectly timed the bottom on this company. Again, obviously up 70%, whatever that would be roughly on that in a year, with a company that, I mean, my yield on cost is probably like 3.5–4%. So, and not only that, they're growing very nice. So this is a company that I would love to buy if we get dips. The problem is, I think a business like this will face, I'm not saying they're going to face a lot of headwinds, but they'll face more headwinds than they faced over the next decade as opposed to the previous decade. The next one is ODFL. I used to really like this company. I've kind of changed to moderately liking this company. Honestly, the main reason is due to it's gone up a lot this year. Like, I mean, I initially bought in right around 300. I stopped buying at like 330, 340, and it's never came down that much since, right? I mean, this company's up crazy on the year. What is it up here? 32%, right? So again, I would want to see it go below 340, 350. If you look at the valuation, you'll see that it's just too expensive based on where it's at right now. I do still like the long-term potential for this company. And again, another dividend growth stock, which is honestly pretty much every company on here. The next one is Prologis. This is a REIT. Again, REITs with the higher rate environment, I think it's going to be a little bit challenging for them. It's not like it's going to destroy them, but I think it's going to be a little bit challenging for them, which is why I'm not quite as bullish on REITs right now as opposed to a year ago. So again, so those are the honorable mentions. As far as my top stocks go, let's get into them. Alimentation Couche-Tard, this is just an absolute home run. Whenever you can find this company for fair value, you just need to back the trucks up because it's just an amazing company. Again, another dividend growth company, 0.94% yield, but again, they're growing that 22% per year. Again, I just absolutely love this company. Again, anytime that it's on sale, I will be buying. Again, maybe it's just a small, very small position, but I'm going to buy every time this company goes on sale. Again, OLED, this is another one I've talked a lot about before. Another example of that. Again, I actually bought some of this company. My cost basis is in the low hundreds, maybe 110 roughly. I know I think it went down to about 91 at one point. So let's see where it was. No, it was around 100. So again, I timed this one pretty good, although I did keep buying up until about 140. So cost basis is probably like 120, 130. But again, a very good company. Again, another dividend growth stock. I think they're in an industry that's going to see a lot of growth, like a lot of growth. So again, that's why I like this company. The next one is Visa. Visa may be one of the best businesses in existence right now because their profitability margins are just absolutely phenomenal. Again, another dividend growth stock. But again, you look at their gross margins. I mean, they're averaging like an 80% gross margin, operating margin, like they're averaging like 65%. Free cash flow margin, like 60%, operating cash flow, about the same. Again, so they're insanely profitable. It's possible that they'll face headwinds in the future with competition, but where things stand right now, they're just an absolute no-brainer. If you can get them at a good price, you buy. At least, again, obviously everything here, my opinion. The next one, Accenture. I think this is just another example of a must-own company. The consulting business is not going away, and they are one of the best companies in that business. Again, another dividend growth company. I think, like I say, I think all but three of the companies in this portfolio I would consider to be dividend growth. So 17 of the 20. The next one is Amphenol. Again, this is another company I've talked a lot about before. Again, they're in a good industry. Another thing you'll notice about the companies that I have in here, they're not all not mega cap companies. I think the largest, there's one that I think is maybe 500 billion roughly, but I have a lot of small and mid cap stuff. And again, over the long run, small and mid cap is going to outperform the large cap and the mega cap, right? And that's something that I think a lot of people, again, if you want to beat the market, find those small and mid cap companies that are growing very well. There's going to be a lot of hidden gems in there, and those are the ones you want if you want to outperform the market, because the market essentially is the large cap companies, right? So again, Amphenol, another example of that. Again, they got a $59 billion market cap, so that is a large cap company. But again, the smaller you are, the easier it is to compound, right? So I really like this company. I've talked a lot about it before. They're growing extremely well. They're profitable. They're growing their dividend nice. They got a lot of room to grow that. So again, another example of a very good company. Caterpillar. Again, this is more a play on safety and long-term growth, I think. And again, they're over $100 billion, $145 billion market cap. But I mean, the population of North America, I mean, of the West as a whole, is growing very rapidly. And what's going to need to happen to keep up with that growth? Well, construction. And they're one of the biggest companies that will benefit from construction, right? So again, I really like this company. I think they're going to do very well over the next 10, 20, 30 years. The next one is CN. Again, this is another company that you're not going to see crazy growth from. But again, with a growing population, this company is going to do well. Not to mention the fact that in Canada, at least, you have two railway companies, and they're not number one. They have a basically a duopoly, right? I mean, no one's going to compete with these companies, right? So they have virtually guaranteed business. They have a great moat. They're fairly profitable, and they're in an industry where the demand is only going to go up over the long run, right? So again, I don't think you're going to see crazy growth, but I think that these businesses are still going to do well over the long run, and they're in a very good industry, right? The next one is EQ Bank, again, Canadian bank. Again, this is, of all the banks out there, this is my favorite because it's growing so well, right? I mean, if we go over to the dividend, again, it's only 1.8% where it's currently at. Now, again, I think it's probably a little overvalued where it's at right now. It's literally at an all-time high. I think it just hit that yesterday. So again, I'm not a big buyer on this company right now. Again, honestly, probably the majority of the the majority of the companies on this list, I'm not a buyer where they're at right now. But again, these are companies that these are on my watch list. In fact, I already own every single one of these. And again, if they get to a good value, I will be buying more, right? And again, if we look at the dividend in this company, like I say, 1.8%, but they're growing at 23% per year with a 17% payout ratio. These are the kinds of companies you want because you don't have a high dividend right now, but 10, 20 years down the road, that's what matters, right? That's what matters. You want the high dividend in the future. The high dividend right now is irrelevant, right? So again, another example there. Another example of that would be EQIX, again, Equinix. They're kind of a cell tower / data center kind of REIT. Again, I've talked a lot about them before. Again, they're basically worldwide. They have a good amount of diversification. They've grown extremely, extremely well over the long run. They're growing their dividend 13% per year. Again, this is another example of a very good company, in my opinion, right? Just everything you're looking for. And again, they're fairly well diversified. IIPR, another one I've talked a lot about before. Again, this is a marijuana REIT, essentially. They have the legal grow ops. Again, when I bought this company, this is another example of one that I timed almost perfectly. I bought it, my cost basis is in the high 60s. I believe it got down to about 60. Again, so another one that I've timed very well. They're not going to grow that dividend nearly as quickly in the future as they have. But again, if they can grow the share price 5-10% per year, the dividend 5-10% per year, that's all I'm really asking. And I think that that's easily doable, right? I think that's easily doable. Again, although it is going to be cyclical, there's definitely going to be some times to where it's challenging, but I still do like this company. Microchip Technology, again, another example of an extremely, extremely good company. Again, they're growing their dividend crazy quick. And not only that, again, this is a technology company. This is a semiconductor company. Like, this is just everything you're looking for, in my opinion here. The next one is going to be Paycom Software. Paycom Software, again, extremely, extremely good company. Again, you want to keep an eye on the valuations because this company has historically traded very, very rich. Although I think where it's at right now, this actually can be something that you can look at picking up. So keep an eye on that. But again, another company I really, really do like. The next one is Fortinet. Again, another example of a very good company. This is one of the few companies on here that doesn't pay a dividend. Although, again, if you look at their historical levels of growth, again, extremely good company. Another one that I think you probably could pick up where it's at right now. The next one is going to be Primerica, right? So again, an insurance company. But again, this is an insurance company that's done extremely well historically and continues to do extremely well. Again, they're only a $7 billion company. I think they got a lot of room for growth. They're growing their dividend extremely quickly. Only has a 16% payout ratio. I really like that. The next one is QLYS, or QYL. Yeah, I typed that in wrong. QLYS. Again, extremely good company in my opinion. Again, a cybersecurity company. They've performed extremely well this year, right? Extremely well. Again, they're up almost 50% on the year, which is just crazy good. Another very good company in my opinion. Vici Properties. Again, Vici Properties, they own some casinos and resorts and stuff like that. They're actually down on the year. But again, this is a company, honestly, you're buying primarily because of the dividend. 5.3% yield. They're growing that 7% per year. If they can simply grow the dividend 7% per year, that's the main thing I'm concerned. I mean, if you got a 5.3% yield, you're growing at 7% per year. It's doubling every 10 years. So again, you buy it today, you're going to have a 10% yield 7 years from now, right? Or sorry, 10 years from now. And again, so you're going to have a 20% yield 20 years down the road, right? So again, I really like this company, and I mean, it's one of those things that people just love to spend money on. And honestly, I don't think that they'll see that big of a hit in times of recession, right? So again, they'll take a hit. They'll definitely be cyclical, but I don't think they'll take as big of a hit as people think. The next one is Waste Management. This is another one that's kind of a safety play. I do have a few of those that I would consider to be more safety plays, being Caterpillar, CN, and Waste Management. Waste Management is a business that is not cyclical, right? Because again, it doesn't matter if there's a recession or not, people still need to get their trash taken out. And with a growing population, there's only going to be more trash, right? So I think that this is another example of just an absolute home run. The one caveat is because it's so non-cyclical and it's so safe, at least for a stock, it usually trades at a premium. So you want to keep an eye on the valuations here. ASML, another company that I really like. I think it's going to, even though I think this might be the largest. This is the largest company that it's on my list. $272 billion euro market cap. Again, I think that as far as semiconductors go, this is one of those companies that we pretty much need. So again, I think you're going to see very good growth over the long run with this company. And I mean, they're growing that dividend extremely quickly, right? So again, another company that I really do like, and I think is going to do very good over the long run. The next one is AGM. Again, another nice dividend growth company. Again, they provide financing to basically farms, for lack of a better way of putting it. Again, agriculture finance, rural infrastructure finance. They also do agri-finance, renewable energy. Again, so they're actually somewhat diversified, right? So again, that's why I like it. Also, I like it. I mean, number one, in that it's an industry that I think is going to grow well over the long run. But again, you have a 2.5% dividend that's growing 13% per year. And I mean, my cost basis on this company, I think, is like 140 roughly. So again, I probably got a dividend around 3%. So the last one is going to be automatic data processing. Again, this is going to be a company that's going to be a little bit cyclical, certainly, because they're going to be dependent upon how the economy is doing, how the jobs market is doing. But I mean, this is a company that's historically is pretty safe, at least compared to the market, but you're outperforming the market, right? So again, another company that I really, really do like over the long run. Again, this is another great example of a dividend growth company, 2.4% yield, they're growing at 12% per year. Again, which is just everything I want to see. Again, they're easily outperforming the S&P as well. So that is my top stocks for 2024 and beyond. I will update the list probably next year, maybe halfway through the year. We'll go over things, but I definitely will update it again next year. So again, that is my list. I'd love to hear what other people think. So I'd love comments, feedback, anything of those sorts. Again, if you like the video, please like, subscribe, and stay tuned for more.